What's up guys, welcome back to Might As Well. In today's video we are again going to analyze another company. But before I start out with the actual video, I would like to remind you that if you find these kind of videos helpful, to make sure to like the video for the YouTube algorithm. With that aside, let's start out already. For today I decided to go with Leggett Platt, which is probably one of the lesser known companies out there. But let's start with the usual introduction. Leggett & Platt is a company based in Missouri from the consumer discretionary sector that focuses on the production of bedding products, furniture, other residential and office furnishings, as well as a lot of more different products. But for now, let's have a look at the key financials Leggett & Platt has to bring to the table. As we can already see, the company is still one of the smaller ones, which only brings a valuation of about 4.4 billion to the table. Don't get me wrong, this is still a fairly big company, but if we compare to the usual company on this channel, this is still fairly small. In addition to that, the company has managed to earn a total revenue of about 4.7 billion US dollars in the last year. But let's dig into that a little further and explore the sectors of the company's revenue a little bit more. Generally speaking, Leggett & Platt divides their revenue into four key segments, which are residential products, industrial products, furniture products, and specialized products. If we now sort these from the biggest to the smallest, we get a graph that looks something like this. With the biggest one being the residential products that contribute 2.3 billion US dollars. This one is then followed by the special products, which contribute 1 billion US dollars, which are then very closely again followed by the furniture products. But last but not least, we have the industrial products, which contribute the final $295 million. But enough with the introduction, let's get to the actual distributions to shareholders. At the point of making this video, Leggett & Platt currently returns capital to shareholders through dividends and stock buybacks, which, if you ask me, are pretty equally weighted when it comes to the amounts distributed through them. But at first, let's focus on the dividend, which currently sits at right about $1.60, which would equal a current yield of about 4.72%. But since Leggett & Platt is a fairly old company, let's not ignore its distribution history, which is also really impressive if you ask me. If we, for example, take a look at the company's dividend history, we can see that it offers 48 years of consecutive growth. Unfortunately, I was unable to reconstruct Leggett & Platt's dividend history for a longer time frame than that, as they also don't have any information on their website about a longer spectrum. However, although the company has been paying out these distributions for a really long time now, they are also still able to grow them. If we just look at the past 5 years, we can see that they have been managing to grow them at about 5.31%, which is pretty average, I would say. If we now also factor in the stock buybacks, these stay fairly around the same point. But let's take a look at the actual numbers. As you are able to see in this graph, generally speaking, Leggett & Platt's free cash flow goes up. However, if we ignore the big picture, you can see a lot of retractions that are then followed by an increase. This is due to the nature of Leggett & Platt's business, being a cyclical one, which means that if the overall economy does great, the company also prospers. But since our main goal is to find out whether the distributions are sustainable, let's put the dividends into contrast with the company's free cash flow. Here we can see that although the dividends constantly increase, they permanently stay below the free cash flow, which obviously is a very good sign that indicates to us that paying out dividends at this pace is indeed sustainable. However, as we've previously already mentioned, dividends are not the only form of compensating shareholders. So in order to get the real distributions to shareholders, we will have to add the amount spent on share buybacks to the paid out dividend, which already looks less sustainable than just simply our dividend. As you can see, the complete distributions to shareholders exceed the free cash flow of the company in every year except for 2016 and 2019. This in the long run means that the company has to take on debt in order to be able to pay out at such a pace, which is obviously fairly unsustainable in the long run. But let's have a look at the company's balance sheet in order to actually see how long the company can afford this trend. As always, let's start out with the year of 2015, in which Leggett & Platt's total assets sat at about 2.96 billion US dollars. These were made up by about 1.3 billion in equity, 941.5 million in long-term debt, 202 million in current debt, and 509 million in non-interest paying capital. In order to actually understand these numbers and get real information out of them, as well as help us evaluate how good the balance sheet actually is, we will now calculate the net debt. This is obviously done using the company's debt and its cash position. For the case of Leggett & Platt, we get a net debt position of about 890.3 million US dollars. But for now, we are gonna put that value to the side and get back to it in just a second when we calculate the sustainability ratio. But for now, let's jump to the year of 2019. As you are able to see, Leggett & Platt's total assets increased by a pretty significant amount over these few years. In the year of 2019, their total assets sat at about 4.8 billion US dollars. These were made up by about 1.5 billion dollars in equity, 2.18 billion in long-term debt, 51 million in current debt, and last but not least 1 billion in non-interest paying capital. But let's again calculate our net debt position for the year of 2019, which would come out to be 1.99 billion US dollars. As we've already quickly seen, over our time frame, Leggett & Platt's debt position has definitely grown by a somewhat big amount, but let's have a look at whether this debt has gotten more or less sustainable. If you are a usual viewer, you will now probably already know what is coming. In order to calculate how sustainable the company's debt is, we need the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. In the case of Leggett & Platt in the year of 2015, this sits at right about 598.7 million. If we now do our calculations, this would come out to equal a ratio of about 1.48 or 148%, which would mean that if Leggett & Platt wanted to do so, it could pay off all its debt in 1.5 years. However, keep in mind, for that they would have to stop rewarding shareholders through buybacks and dividends. If we now do the same thing for the year of 2019, we get a ratio of about 2.8 or 280%, which would mean that the time frame in which the debt could be paid off already increased to a little less than 3 years. As investors, we are all well aware that the past is a nice indicator, but not everything. That is why I always try to get an estimate of what the financial future of the company could possibly look like. In order to assess this, we usually take a look at the company's past revenue and its pre-tax, pre-interest trend. If we now do this for Leggett & Platt, we can observe that their revenue, generally speaking, goes up. However, as we've previously already discussed, we again somewhat see the cyclical business of Leggett & Platt in the revenue. This time, however, it is to a far lesser extent, with just a fairly small pullback in 2016. But as always, let's not ignore the EBIT, which we obviously also have to take a look at when trying to assess the financial future. This one, however, looks a little bit different from the revenue. If you look at the graph, you can easily see that we have somewhat of a pullback from the year of 2015 to 2018, which then again bounces back in 2019. This means that over the years, the business has somewhat gotten less profitable, obviously except for 2019, but more on the reasons why it jumped back up again in 2019 in the next section. Alright, after having all of the financials covered, we still want to take a closer look at the company, which will also influence our margin of safety later on. At first, let's lay out some of the benefits that Leggett & Platt brings to the table. To start out, I want to at first talk about one thing that in my opinion makes Leggett & Platt a company to buy and hold forever. This would basically be the constant need for furniture, as well as comfort, for example with mattresses or car interiors. Since I can see the trend of us sleeping in beds with mattresses changing in basically any time soon, I think there will always be somewhat of a spot in the market for a company like this. Therefore, I will reduce my margin of safety by 10%. My second argument for the company is also somewhat closely tied to the previous one, and that is that with the acquisition of Elite Comfort Solutions, as well as the restructuring of their home furnishing segment, Leggett Platt positions itself even better for the future, as they improve their margin through the restructuring process, as well as grow their capitalization in the online as well as in the retail market. But for that reason, I'm again going to reduce my margin of safety by another 5%. But it's as per usual not all roses and butterflies. So let's move on to the downsides the company has. First of all, I'd like to point out that Leggett Platt is in my opinion not really the right company if you're looking to get returns through market gains, as I more so see them stagnating over the time. I do not only say that because I don't really like the current trend the balance sheet is following. Yes, I know some of the debt is from the acquisition of ECS, which at the end of the day is a good thing. But I also think that a business in such an industry is fairly hard to grow to a big extent. Therefore, I'm going to add 5% to my margin of safety. My second downside to the investment is something that is fairly bound to the current market situation, which obviously can be attributed to the whole Rona situation. As I've previously already said, Leggett Platt is a cyclical company that depends on the economy to prosper. With however a huge stake of the population being out of a job, something like that is not really a priority. Sure, they sell directly to retailers, but if they don't sell their inventory, they obviously can not buy new products from Leggett Platt. For this reason, I'm expecting a few harsh quarters for Leggett Platt, which I think can however be managed by downsizing and so on. Yes, this brings problems on its own, but that would break the spectrum for today. Last but not least, for the previously mentioned reason, I will add another 10% to my margin of safety, which leaves us back at our starting point of about 25%. But let's actually get the fair price for the company and the amount I would be willing to pay for Leggett Platt. In order to get the fair value of the stock, we have to take a little look at the historic dividend yield. For the past 10 years, we had an average dividend yield of 3.63%. This obviously means that you want to buy the stock if the yield is above that average. This would mean, with the current dividend of $1.60, the fair price to pay would be $44.07. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.63% and my safety margin of 25%. This gives us a target yield of 4.53%, which leaves us with a price to buy the company at of $35.32. Thanks for watching, and this was Might As Well.